Whether you think a mortgage is an asset or liability, it is imperative to know how it works and then decide for yourself. Taking a mortgage is one of the biggest financial decisions you will ever make. And so by the end of this video, you will have a grasp of how mortgages work and how to choose the right one for you if need be. If terms like fixed rate, ARM, and amortization sound confusing, you are in the right place. Here is what we will cover: what a mortgage is and how it works, the different types of mortgages, key terms you need to know, and how to choose the right mortgage for your situation. Let's start with the basics. What exactly is a mortgage? A mortgage is a loan you take out to buy a home. You borrow money from a lender, like a bank, and agree to pay it back over time, usually 15 to 30 years with interest. Think of it like renting money to own your home, with the house itself acting as collateral. Now, if you don't keep up with payment, the lender, of course, can take back the home, which is called a foreclosure. Next, let's look at the different types of mortgages available and what makes them unique. Here are the most common types. Fixed rate mortgage. Here, the interest rate stays the same for the life of the loan. This is great if you like stability or predictable payment. Adjustable rate mortgage, ARM. Here, the interest rate can change after an initial fixed period, which means your payment might go up or down. FHA loans. These are government-backed loans for first-time buyers with lower credit scores or smaller down payment. VA loans, designed for veterans and active military personnel. These loans offer benefits like no down payment. And jumbo loans for expensive homes that exceed standard loan limits. Each type of mortgage has its own benefits and risk, so it is imperative to pick the one that fits your financial situation. Now that you understand the basics, let's decode some common mortgage terms. Here are some terms you will encounter. Principal, the amount you borrow from the lender. Interest rate, the cost of borrowing money expressed as a percentage. Amortization, the process of paying off the loan through regular payments. Down payment, the upfront cash you pay toward the home, usually 5 to 20% of the purchase price. Escrow, a third-party account where money for taxes and insurance is held until it's due. Now that you know the types of mortgages and the key terms, how do you choose the right one for you? Here is a step-by-step guide. Assess your budget. Know how much you can afford. Use the 28-38 rule. No more than 28% of your monthly income on housing and 36% on total debt. Shop around. Compare lenders and their rates. Don't just go with the first offer. Check your credit. Now, a higher credit score will give you a better interest rate. Think long term. Are you staying at home for a long time? A fixed rate mortgage might be better. Planning a move in a few years, an ARM could save you money. Remember, the goal is to find a mortgage that fits your needs and keeps your financial future safe. Finally, let's cover some mistakes people make with mortgages and how to avoid them. One, of course, not shopping around. Don't accept the first offer always. Compare multiple lenders, ignoring hidden costs. Consider taxes, insurance, and closing costs. Overextending your budget. Just because you qualify for a big loan doesn't mean you should take it. Skipping pre-approval. Now, sellers take you more seriously if you are pre-approved. Mortgages might seem complicated, but with the right knowledge, you can navigate the process with confidence. If you found this video helpful, give it a thumbs up and subscribe. Do you think a mortgage is an asset or a liability? I would love to hear your story.